I wanted to go through some finance mistakes that we have seen can really cost growth in a startup. And I've got a few that I want to go through. And basically, what is the mistake that was actually made and what should have been done instead? Hi, my name's Alysha Randall. I'm a fractional CFO for Fast Growth Consulting. And today, as I said, I wanted to go through just those finance mistakes. I'm very much thinking about it from a finance perspective, but obviously this has a bigger impact across the business rather than just having a misposting in your profit and loss. So if you are a founder within a startup or scale up, there's probably is a good chance that you've done maybe one or two of these mistakes before. And, while finance mistakes can obviously cost you money, some of them might really kill momentum entirely, especially if you're preparing to fundraise or you're looking to make that next hire. So here are some of the mistakes I wanted to go through. Number one is ignoring cash until you're short. So the mistake is you're looking at your bank balance every single day. You make payments based on what's in your bank balance instead of looking at that longer term cash flow forecast. So by the time you notice there's a real dip in your bank balance, it might be too late and you may be struggling to get out of that hole. So what needs to happen instead is it does need to be at least a 13-week cash flow forecast, and it actually gets updated on a weekly basis. If you have somebody like me, then you would not only have that, you would also have a 12-month forecast. So if you're able to put a cash flow forecast together, I would highly recommend that you do that. I did actually talk about cash flows in much more detail, and I'll leave you a link for that above so you can click through to that if that's something you're concerned about. Number two is hiring without reviewing the numbers. So adding headcount just because somebody says in your team that you're under-resourced before really checking the long-term, particularly support functions that aren't really revenue generating or product generating roles. So for this, I have created a hiring calculator. You can access that above or below. This factors all of the costs associated with hiring someone, but there's also do need to think about obviously other elements, not just finance, but we're focusing on finance right now. A perfect example of that is I worked with a company whereby they were heavily reliant on a strong sales function because they were B2B and B to enterprise even. And so, if you looked at just the numbers, hire a really experienced sales hire in that team, just focusing just on the numbers for today probably wouldn't have made sense. But if you're looking at what they're going to bring to the company over time, and also if you had a cash flow forecast, it would show you the revenue that this particular salesperson may achieve, then it's worthwhile doing that full exercise rather than just looking at a calculator. But obviously a hiring calculator is useful because it does show you all of the different costs outside just their salary. Number three, delegating finance too late. So assuming you have a tax accountant or a VA that can handle financial operations until you're much better, or even your external bookkeeper that just keeps the lights on and that's all. So most people that we come and work with, that's exactly what they have. They have a tax accountant that probably only updates your numbers properly once a year. And when they have to do the tax returns, they may do the VAT returns for you as well, and maybe even your payroll, but providing you with monthly financial numbers that really help you drive the business, they probably don't do that. So once you're hitting about £50,000 plus, or say 75,000 US dollars in monthly revenue, you really do need to have proper finance support and leadership. So whether that is a in-house financial controller that can give you a bit more insights, or a fractional CFO that can really help you plan the next 12 to 18 months and get those commercial insights from your numbers. This will really help you to make sure that the business decisions you're making are the right ones, and also help you for potentially a next fundraise. So Again, if you want to read more on what a finance team should look like at all the different stages, I'll leave a link for that above and below. Number 4 is budgeting from scratch each time. So the mistake is creating a new budget. Let's say it's on Excel or Google Sheets every year without any link to strategy. So what should be happening instead is you start with your vision and your mission, you map out your long-term strategic goals for the next 12 to 24 months, and then you break each of those goals down into the stepping stones, or say your operational targets, that you need to achieve in order to get to that bigger goal. And then once you've got all of that, then you layer on your cost requirements. So for example, we need another person in our sales team. We need a CRM to hit those sales targets. There are obviously 2 financial considerations that would need to go in the budget. But you start with all of that understanding and planning first before you start budgeting. And then you use last year's data, plug in the known changes, and build a realistic and measurable plan. Sounds easy, right? So we have engaged with founders before where their first question is, can you please give us a growth model for a fundraise, or we need a budget to manage our costs and our cash flow forecast. And I say, great, we can do that. What are your strategic and operational goals for the next 12 months? And a lot of times, unfortunately, what we generally get actually is the strategic goals are there, but potentially not the stepping stones in order to achieve that. It might quite often be in the founder's head, needs to be written down and communicated to the team. And then once that happens, then we have a good understanding of building a budget. Number 5 is using management accounts that don't help you manage. So the mistake is you get a monthly P&L, say from your tax accountant or bookkeepers, and you don't really read it, maybe because the numbers don't really tell anything, or even worse, you don't even know what the numbers mean. So I have seen some shocking monthly reports. Some of the ones that I see is, say you have multiple companies and I see a financial numbers for each separate company individually, and that gets sent to the leadership team. It's very difficult to run a group of companies if you have that. I have seen P&Ls or income statements where you have all the revenue in one line. It just says sales or revenue at the top, and then all of your expenses are in alphabetical order underneath. Again, how do you know what your profitability is on different products? How do you know what's giving you revenue? How do you know if you've got gross margin or not? How do you know if you've got contribution margin and it's worthwhile investing in sales and marketing? You can't answer any of those questions. So what you should be doing instead is setting up a proper storytelling monthly management accounts with commentary, trend analysis, cash tracking, a short founder-friendly summary, and it should be able to scan your pack and make decisions immediately. So if your accountant isn't able to do this for you, and often they can't, particularly if they're set up as your tax accountant that does bookkeeping, then it might be time to get a specialist to help. So this is something that we can help you with. Number 6 is treating finance like admin instead of strategy. So I see this often with first-time founders who haven't really worked in the corporate world before and therefore potentially haven't interacted with a strong finance function. So they probably just see finance as a compliance function that only really exists to file tax returns, pay invoices, and calculate payroll, and that's it. So you really do need to shift your mindset if that is you. Finance really is the engine room from scaling. So good finance helps you price, it helps you forecast, it helps you hire, helps you raise, helps you grow, and with data to really back you. So make finance a strategic partner and not an afterthought. I will say I recently attended Ideas Fest here in the UK. It's a great festival for founders. There's loads of talks. It's like my 2 favorite things, talking about startups and business and festivals, and they've kind of put it together. And there's many either advisors or experienced founders talking about team building, fundraising, operations, etc. that you can attend. One of my favorite talks was from 4 really experienced founders who have all exited their startups. Most of them have started again on their second startup, and get your finance get your finance stuff, shall we say, but a swear word, in order was probably my favorite quote from this talk. And obviously, I couldn't agree more. So all four of them said you absolutely need a strong finance leader to help you. They're really essential to help steering your business forward. So just get it in order. The earlier you can do it, the better. So previously, if you wanted a CFO, you had to pay a full-time salary, which is plus £20,000 a month. But now that fractional CFO is very commonplace, investors almost expect it now, you can get that real experience, insight, and guidance and advisory role without the huge price tag. Number 7 is not preparing early for a fundraise. So this is one that I see all the time. So scrambling to clean up the numbers 4 weeks before investor meetings. Okay, not all founders do wait this long, although I do remember the team and I scrambling to reconcile inventory that was $500,000 out while the founder was having investor meetings. Most founders don't leave it this long. So what you should be doing instead, I would say, you should start 6+ months out. So that's when you want to upgrade your reporting, build your growth model, track your unit economics, build trust in the numbers, prepare your data room, all of these things. And not only that, but hit a certain number of milestones that you want to hit. So this is so critical. And all of these things take time depending on how messy it is. Sometimes it might even be 12 months. So definitely look at doing that. We have a financial foundations package for founders. We come in and get your numbers investor ready. I would say 6 months minimum before that conversations should start. And number 8 is failing to reforecast. So creating a 12-month budget in January and then never looking at it again. This isn't useful for anyone, particularly at early stage. You absolutely should be reforecasting quarterly, or at least reviewing your assumptions in your budget regularly, largely because business plans shift, sales cycles move out, hires get delayed, and your forecast should really reflect what's happening today and help steer you accordingly. So with founders that we work with, we actually review a rolling forecast monthly at a minimum. Whenever there's a new idea, KPIs have changed, or changes to the revenue drivers, or there's a new product or loss of customers or a change in the team, we basically discuss everything while updating the model and see what that does to cash forecast and having a look at the margins. Sometimes when cash gets really tight, either because of seasonality or a fundraiser is taking too long, then we review this model weekly to see how we can make changes. And if necessary, or we pull out a scenario of options that we've prepared for different situations. So I personally feel like if you don't have this view, you really are running your business blind. And I feel that both founder and CFO, I personally run my business this way. Obviously, I look at mine weekly, but that's just because, I have those skills. But I think you should absolutely at least be looking at it monthly until your business is, say, Series B and a bit more stable. But at that earlier stage, 100%. So I will say none of these mistakes make you a bad founder. I will say all of the founders that we worked with have at least one of these things that we come in and help you fix. Some of them are actually quite technical, so I wouldn't expect most of the solutions you personally actually fix outside, say, the strategic planning. I would just say that this is what you need. And if you feel that you're not doing that, there's quite a few repercussions, which I've kind of mentioned. These mistakes really do hold your business back, especially when you hit that awkward middle ground between a scrappy startup and an investor-backed scale-up. So that is the point, if you've got product market fit and you want to start growing, that is the point where you really need to step up your game in the finance. Obviously, if you want help building a finance function, your growth deserves, you want to check out our services on fastgrowthconsulting.com or take a look at our free resources. We do actually have a scorecard for to check if you're investor ready or not, if that's something that you're interested in. So if you want a finance function that's really built for fast growth and future fundraising and not just compliance, here's how we can help. You can subscribe to this YouTube channel. I'm trying to post by twice a month rather than just once a month. We have a monthly newsletter that also goes out that has lots of advice in it. We have loads of free tools, including a fundraising checklist and a hiring calculator that I mentioned earlier in this video. And then if you want to work through with our team, with our financial foundations to get you investor ready within a few months, then check that out and book a call with one of us. Anyway, thanks so much for watching. Hopefully you found that useful, and I'll see you in the next video. Cheers.